Adopting an accurate costing method will not only help you estimate costs reliably, but it will also ensure that you are able to set selling prices that will cover all the costs, hence lead to a profit. In the first part of this series, we will look at traditional costing methods of marginal costing and absorption costing. Hello and welcome to the Accounting Feed. My name is Philan and I'm your host for this session. Let's start with marginal costing. The overall idea in this costing method is that marginal cost of a product is its variable cost. That is, the cost that changes or varies with the level of activity or the number of units produced. These include marginal cost of production such as direct materials, direct labor cost, as well as any variable production overheads. These costs will increase as the volume of production and sales increase. In contrast, fixed costs are those costs that will remain unchanged over time regardless of the volume of production or sale. From this discussion, it can be seen that marginal production cost can be avoided if production does not take place. So let's say these costs will increase with an additional unit of production, and this can be illustrated in this graph where you can see cost and units of production. So the variable cost is rising as the units of production rise. Now, before we get into further details, please drop a like on this video to help us reach as many audiences as possible. So how do we define marginal costing? Marginal costing can be defined as an accounting system which takes into account variable costs when determining the cost of units produced and writes off fixed costs in full against the gross contribution. This method is appropriate in short-term decision-making situations. The reason for this is because it allows management's attention to be focused on the changes which result from the decision under consideration. The concept of contribution. Contribution is a critical concept in marginal costing. It can be defined as the difference between sales revenue and variable costs. Contribution per unit can be calculated as follows. You take the selling price and you deduct variable cost per unit. That will give you contribution per unit. To get the total or gross contribution, take the contribution per unit and multiply it by the sales volume. So as you can see, contribution per unit, I've designated A there. You multiply it by volume of sales, that is B, and you get the gross contribution. Alternatively, you can take total sales and you deduct total variable costs as follows. So total sales, which is selling price times volume, right there, and then total variable cost, which is variable cost per unit times the volume sold. That gives us gross contribution. When making short-term decisions, profit is not of particular importance since it depends on the volume of sales. As such, contribution is a more relevant concept. The idea of contribution stems from the fact that a business should be able to generate revenue enough to cover all the variable costs and periodic or fixed costs. Therefore, the difference between sales revenue and variable cost, that is contribution, is the amount that is expected to cover or contribute towards paying fixed costs. Take note of the following. If contribution is more than fixed costs, then we made a profit, but if it is less, then we made a loss. If contribution is equal to fixed cost, on the other hand, then we are at a break-even point where there is no profit or loss. So how do we calculate profit using marginal costing system? Here we have to take the gross contribution and we less fixed costs to give us the profit. Marginal income statement will look like this. So you have the sales, you less cost of sales, which is opening inventory plus variable cost of production, less closing inventory. And then, of course, from there now we can deduct other variable costs to give us contribution, and then we less fixed costs to get the profit. Note that opening and closing inventory in this system are valued at marginal or variable costs. Fixed costs actually incurred are deducted from contribution in order to determine the profit for the period. Advantages of marginal costing. Number 1. Contribution per unit is constant, unlike profit per unit, which varies with the changes in sales volume. Hence, it is helpful in decision making. 2. there is no under or over absorption of overheads, and hence there is no adjustment required in the income statement. 3. Marginal costing is useful in decision-making process. And 4. It is simple to operate. Disadvantages of marginal costing. In this method, it can be difficult to analyze overheads since separation of costs into fixed and variable can be problematic, especially if there are semi-variable or semi-fixed costs involved. Secondly, closing inventory is not valued in accordance with accounting standards, and that fixed production overheads are not shared out between the units of production, but instead they are written off in full. Before we take a look at the next method, let me take this opportunity to remind you to subscribe if you are yet to. It only takes a second. Do not forget to hit the notification bell so that you do not miss any of our future uploads. So let's move on to absorption costing. The idea in this system is to build up a full production cost which incorporates all costs, both direct and indirect. Overheads are included in the production cost using overhead absorption rates. To calculate overhead absorption rate, you take budgeted production overhead divided by budgeted total of absorption bases. When overheads are absorbed into cost units, an under or over absorption can arise. The basis of absorption can be labor hours, machine hours, volume, etc. So how does absorption costing income statement look like? As you can see, we start with the sales less cost of sales, which is opening inventory plus variable cost of production plus fixed overhead absorbed less closing inventory. From here, we now adjust it for under or over absorption. So as you can see, under absorption is deducted, over absorption added. Now this will give us gross profit. If we deduct non-production costs, we end up with profit or loss. Note that this time, opening and closing inventory are valued at full or total production cost, unlike in marginal costing. There is also an element of under or over absorption of overheads. This is an adjustment necessary if the estimates of the budgeted overheads or budgeted level of activity are different from the actual results for the year. Advantages of absorption costing. This method includes an element of fixed overheads in inventory, and hence it is consistent with accounting standards. Secondly, the system is advantageous for small entities since absorbing overheads into costs is the best way of estimating job costs and hence profit on jobs. Thirdly, an analysis of over or under absorption overheads is important in helping the entity control its costs better. Disadvantages of absorption costing. The main disadvantage of absorption costing is the fact that it is complex to operate unlike marginal costing. In addition to this, it also does not provide useful information for decision making. Secondly, this method can lead to skewed profitability in that it can make the company's profit look better than it actually is during some periods. And this is because all fixed costs are not deducted from revenues unless all the company's manufactured products are sold. Effects of costing method on inventory valuation and profit determination. From our discussion, we've noted that marginal costing values inventory using total variable production cost, while absorption costing values inventory using the total production costs. As such, opening and closing inventory values will be different under marginal and absorption costing. This effectively affects the value of profit. Remember that profit and closing inventory, which is an asset, have a direct relationship. This means that if the closing inventory is rising, the profit will also rise, reconciling profits under the two costing methods. Please note that if closing inventory is more than opening inventory, absorption costing gives a higher profit since it uses full cost, that is, variable and fixed costs. The reason behind this is that closing inventory is deducted when calculating the cost of sales. So if it rises, cost of sales will decrease and hence profit will increase. In a similar situation, marginal costing will produce a lower profit. In the same vein, when closing inventory is less than opening inventory, the profit under absorption costing will be less since a higher amount of fixed cost is contained in the opening inventory. This makes the cost of sales figure high. In a similar situation, however, marginal costing will provide a higher profit. This marks the end of our session today. Thank you for watching, and until the next one, cheers!